Hey guys, welcome back. In today's video, I'm going to be showing you guys some R code that seeks to find which moving average is the stickiest, meaning that the prices gravitate towards it. We're also going to see if it retraces or bounces off of that moving average. So what we're looking at is the 9-day SMA for the SPY. And according to the code, this moving average produced a total of 30 instances where the stock touched the moving average and then retraced. So year to date, we have 2 instances. And as you can see, the high of the day for this very first bar is very close to the moving average, but it closed far away. And the way we measure the retracements is if the minimum distance between the point closest to the moving average and where it closed is at least 1%. The second instance is this red bar over here, where again the high is basically touching the moving average, but we closed far away from it. Another condition that we have is that the bar cannot cross over the moving average. So the purpose is just to find out if there's some sort of pattern in the length of the moving average along with the moving average type, which you can use exponential, simple, and weighted, and see if we can detect some noticeable patterns. So let's go ahead and take a look at the script. We're going to start off by requiring the QuantMod package. We're going to assign the symbol we want to analyze and get data from Yahoo Finance. Now we're going to go ahead and build a function where we pass in the symbol. We have the start and end date for calculation purposes, the moving average period, the moving average type, and the threshold. The threshold is measured as a percentage. So we're going to go ahead and pull the data from our working environment. We're going to subset to the date range. We're going to extract the closing price to calculate the moving average depending on the type. So again, you can use the SMA, EMA, and WMA. We're going to remove any NAs from the data, and it'll add 4 columns to measure the distance between the open, high, low, close and the moving average, which all get returned as positive values. We're going to use those 4 columns to find the minimum distance, and that's going to tell us if throughout the day we were close to the moving average. We're going to find whether or not the bar crossed the moving average. Next, we're going to add a retrace column where we check the difference between the close and the minimum distance to the moving average, and that value has to be greater than or equal to 1%. We're going to check which bars meet the condition where the minimum distance is less than or equal to our threshold, where the bar did not cross over and also retraced. So it'll return a 1 for true and 0 for false. We're going to sum the total retracements or bounces, and finally we're going to return all the data as a list. So it'll return the symbol, the MA period, the MA type, the number of bounces, the bounce date, and then the data. So to test out the function, our test data will be year to date, the MA period will be 9, the MA type will be SMA, and the threshold will be 25 basis points. And we're going to use our function and pass in all of these variables, and we're going to save that into result. So as I mentioned, it'll return a list where we have the symbol, the MA period, the MA type, the number of bounces, and the bounce dates, along with the data and all of its calculations. So if we plot the results, we see that we only had 1 bounce, which occurred in late March, but we can use our function to pass in multiple lengths for our moving averages. So here I'm just going to set the MA lengths from 9 to 100. Our start date will be from 2020 all the way to April 11th of this year. We're going to continue using our SMA, and we're going to continue using our 25 basis point threshold. And if we take a look at that data frame, we have the moving average and the number of bounces or retracements. And we see that the moving average ranges from 9 all the way to 100. So by using this table, we're going to go ahead and extract the one that has the most bounces, which is the 9-period moving average. So if we go back to our script, in the next block, we're going to use which max to extract that moving average, extract the data, and then plot it, which is the chart I showed you at the beginning of the video. But you can definitely modify the code to fit your needs. And with that, guys, this concludes the video. I hope this was useful information. I'll leave a link down in the description area to my Patreon where you can find the script. Please consider subscribing to the channel if you haven't done so already. Thank you so much for watching, and I'll see you guys in the next video.